Welcome everybody, and thanks for joining me for today's live discussion about the recently minted central bank digital currency of Jamaica. If you can hear me and if you are seeing me loud and clear, make sure to drop a hello in the chat and let me know that from the tech side everything is working fine. And I want to welcome today's guests, Trevor Forrest from 876 Solutions from Jamaica and George Connolly, the president of One Ledger from Barbados. Welcome, gentlemen.
Thank you so much.
Thank you for having us, Simon.
All right, so I'm really looking forward to our discussion because I think everybody is going to learn something new today. So before we do that, I want to give a brief introduction about the history of money to make sure everybody is on the same page, because I think to talk about these topics, it's important to ask the right questions and to get some context about the whole topic: money, currency, value, inflation, etc. So what is money? Where is money or currencies coming from? So when we think back in the day, we basically had a bartering system where basically we traded goods for services, meaning I'm a farmer, I have some crops, I have some corn that I just harvested, and Trevor is a doctor and I trade my goods for his services. That works for a certain period of time, but also has some or brings some problems with it. And that was basically when the first time currencies were invented. And when we talk about currencies, there are a few criteria that a currency has to fulfill to actually work as a currency, as money. And I'm sure we will talk about that a little later, but I want to mention these criteria really quick. So one is durability. So to get back to the example, when I'm a farmer and I just harvested, I'm pretty rich because I have a lot of products, but I cannot really store that stuff because it will spoil. So that is a problem when it comes to the bartering system. Then a currency also needs to be portable, because I don't want to have or it should be able to move it quickly from point A to point B to enable trade. It also should be divisible, meaning I should be able to divide it in smaller amounts. That's why we have a dollar, and that's why we have cents today, for example. It should be uniform, meaning a dollar is a dollar, no matter where, depending or different to a product that can have a different quality, different features, etc. It also needs to have a limited supply, and I think that's especially important later in this discussion, so that it cannot be replicated without losing value. And it needs to be, or it has to be acceptable by different parties, or by as much parties as possible. So durability, portability, divisibility, uniformity, limited supply, and acceptability. There are probably more, but we keep it at that point. So that was then when we used precious metals to pay things, when we used gold and silver, because they combined a lot of these features back in the day. That's when that was basically when we minted the first coins, or when we invented cash. That still had some problems because gold is really heavy, so you have the portability problem. And then some smart person said, all right, let's invent paper money. That the Chinese, I think in the 7th century, started with that, where they basically, the idea behind that was basically, all right, we have paper, and that represents the gold that I have somewhere back in the room over there, and we can always trade that paper money back to gold. Fast forward a few hundred years, we have this First and the Second World War. And after the First World War, Germany lost that, as you probably know, and now Germany has a lot of debt that it has to pay to the winners of the war, because war, generally speaking, is a very expensive thing. So what was Germany doing? Because we had paper money at that point that was tied to gold, meaning we had a gold standard back in the day. Germany said, all right, we kind of erase that and we start printing money to pay the debts that we have to the other countries all over the world. And that was in the Weimar Republic and famously led to one of the first big hyperinflations that we had. I know stories from my family where it literally was, you got your paycheck and you start running to the bakery or to the farmer or whatever to buy some food, because at the point you get there, your money might already lost all the value, and where people literally have paper in buckets to pay their bills. Then, a few years later, the Second World War, 1944, basically the Allies came together and said, well, war and money and economy, that's still a big problem. We need to kind of figure this whole thing out. And we had the Bretton Woods Conference. You can Google that if you want to learn more about that, where basically the US said, all right, we are the leading currency of the world right now. We own 2/3 of the gold supply that is available all over the planet. And we are the leading currency, and everybody else's currency is kind of tied to the US dollar. That's why we still today have the as global payment system, basically the US dollar, when we talk about international trade, commodities, and so on. Fast forward a few years to 1971. The US is in a war again, the Vietnam War, and again, war is expensive. So at that time, or during that time period from 1944 to 1971, we had again the gold standard, meaning every dollar that the US central bank or the federal bank printed was basically, at least in theory, tied to the gold reserves that they have buried down in Fort Knox. So you were, at least in theory, able to change or to trade, I think, 1 ounce of gold to $35, meaning also the price was fixed. Although, interesting fact, as a citizen, you couldn't do that because it was illegal for US citizens to own gold. That was more on an international level. And then we have 1971. Again, the US is fighting a very expensive war and needs money. So I think Nixon said, okay, screw the gold standard. That's done now. And we start printing money again to pay, basically all the bills that we have to pay to finance that war. Fast forward, let's say 2008 or whatever time period you want to pick. We have now computers. We have now more and more of the money existing in bits and bytes. I will talk a little later about things like cash reserve, maturity transformation, and so on. I think these are also interesting topics that tie together in the whole thing. But that was basically then the first time after 2008, after the big financial crisis, where smart people came together and said, something with the money system controlled by a few banks that can screw up the whole world economy is maybe not the smartest solution. Maybe we can find something else that can work as currency. And that was basically when, what is the Japanese name? Satoshi Nakamoto, exactly. Basically came up with this white paper inventing Bitcoin based on a blockchain technology, which is basically a decentralized system, meaning there's no central bank that has control over the currency, over the monetary policy, etc. So that is what we know today as cryptocurrencies. And then now you sometimes hear in the media, or in that case, when we talk about the newly minted central bank digital currency of Jamaica, now we hear also the term digital currency. And I think it's important to make the distinction between a digital currency that is controlled by a central bank, and on the other hand, a cryptocurrency, often or basically on the blockchain, which is decentralized, meaning there is not one entity that has control over the money supply, etc. So I want to keep it here just to make sure that everybody is on the same page. And well, maybe one thing, and that's basically why we have today fiat currency, because fiat currency comes from the Latin word, which you can roughly translate. So it should be basically per order. So the value, well, the money that the currencies that we're using today doesn't have any value or any intrinsic value by itself. It's not backed by any gold somewhere. It's basically backed by the trust that we have in the currency, that we can buy something with it tomorrow. And if you want, you can say, okay, it's maybe backed by the economy that stands behind the country or the currency where it works as legal tender. All right, that was a long monologue. And now, gentlemen, I want to invite you to share your thoughts, your ideas about the whole topic. I want really open the stage for discussing the pros and cons, the problems, and everything around that, because I'm definitely not the expert when it comes to the technical side of things. So maybe I can hand over to you guys.
Well, I'll say this. Let me just start by saying I'm no financial expert either. But just by virtue of the fact that, you know, I have certifications, in blockchain as a blockchain architect, and we have to learn all of this stuff. And I think what how you encapsulated, the history of money, because I'm just here smiling because it's like, it's such an interesting history where when you look at it and see where things came from and how we got here. And it speaks a lot to, okay, there are many schools of thought about where we are now, right? And the whole advent of blockchain and cryptocurrencies and digital currencies on a whole. And when you look at the history, when you go back to those times where you had a major shift every point at these major shifts in what we call the financial system, in those major points in time, there were always these competing schools of thought, right? And then out came something at the end of the straw. So, but I think it was a really good, summary of the whole thing. I think though that we're kind of living in some very interesting times because, as you rightfully say, when they had the major financial meltdown in 2008, it caused a lot of questions to be asked. The trust factor in the existing financial system, given what happened, the technologies that existed, the emerging technologies, really causing people to question the trust of the systems that we were used to. Which, if you read the Satoshi Nakamoto paper, you'll see that there were some real flaws, so to speak, in the existing system, which is what the whole idea behind this peer-to-peer concept, with blockchain as the underlying technology was meant to solve. And I think it for me, blockchain technology, like I say in every one of my presentations, blockchain technology and what sits on top of it will do for value exchange what the internet did for information exchange. Fundamental shift in the way things will work. If you're talking about, going into digital economies, digital societies, digital currency transactions or anything of that nature. While blockchain isn't a silver bullet for everything, it is a critical component of moving in that direction and moving into that true digital age. Um, and I think, you know, it's very important for us to pay very close attention to what it can do, especially as we look to move into that digital realm.
Okay, thanks, Trevor, for that, and thanks, Simon, for summary of currency. Now, let me also say that I am by no means a financial expert, and I am by no means a blockchain or CBDC expert. And I challenge anyone who tells you that they are anywhere in the world as well.
Right.
The technology is still emerging, and everyone is trying to learn and understand it. I want to flip the conversation, though, to two points when we talk about CBDCs. And in your summary about the use of cash, and then we talked about the 2008 meltdown, etc. And even go back to the 1930s, commercial banks, for the most part, are the reason that there continues to be experimentation and options to, for lack of a better word, improve the service and flow of currency outside of commercial banks. Okay? And that's why there are always options that are being looked for. The whole process behind it is sometimes, for lack of a better word, onerous, restrictive, slow, unforgiving, and proves to be an obstacle to a lot of business transactions, even more so than the government regulations that may be in place. So that's why digital currency would always become an exciting option. The whole concept behind having blockchain run digital currencies, I think, is driven primarily by the need for us to trade faster and be able to move cash around. And in Jamaica itself, in 2010, Scotiabank, the digital group, a company out of Canada called Carter, and another local conglomerate, Facey, got together to discuss having a mobile wallet sit on digital platform that allows peer-to-peer transactions and B2C transactions on the item. Again, that's a digital currency. And it sort of was a precursor to what the central bank in Jamaica is doing now, where they've actually rolled out a CBDC. But the motivation then is the same motivation now. How do you move along the peer-to-peer transactions and the digital transactions better? And blockchain and CBDCs is perhaps the only option that makes it viable to do it and easy. I think one of the reasons that it wasn't successful back then was because with so many players involved, then what fees do each one get? So the cost of moving a dollar was too high. With a central bank involved, it makes the process a lot easier. And let me just say that even though Bitcoin and that digital currencies as they stand right now are unregulated, I think the future is going to be regulated CBDCs or regulated digital currencies, regardless if they're privately held or not. Global trade is $81 trillion a year. Digital currencies are holding, I think, $3 trillion in assets, moving about 24% of that for transactions. Minuscule in terms of the worldview. If digital currencies really want to get scaled, they have to get into that global trade, GNP, GDP ecosystem, that $81 trillion. And the only way that any government or any economy will let that happen is in a a regulated setting. So this is the first step. So that's my opening salvo on that one.
All right, then let me pick it up from here. But first of all, I want to address some questions that we have in the chat.
Already?
Yeah.
Wow.
Well, we have a lot of comments in the chat, but I just want to remind everybody that you can ask questions, so I can see you guys. I just don't put every comment up because that would be a little too much interruption. But feel free to ask your specific questions in the chat, and as soon as they fit in the conversation, I will bring them up. So I want to focus a little bit or shift the focus of the conversation a little bit on two things. I want to talk about centralized and I want to talk about decentralized, because the current system that we have in terms of currencies and money is a centralized system. That's why we have central banks. We have the European Central Bank, we have the federal bank in the US, and basically every other country has their own central bank where they control basically the currency, the money, as a legal tender, and you usually only can pay with the legal tender that is accepted in that country, meaning all the power, when we say money is power, in that case lays at the bank or at the government, when you say that the government controls the bank. For example, let's keep it simple. Let's say, we are three parties, Simon Küpper, Trevor Forrest, and George Connolly, and we are all at the same bank. So I have, let's say, $1,000 in cash, and I put that into my bank account, and let's say Scotiabank, as you just mentioned. So now I have digital money on some server, the Scotiabank, where it says, okay, Simon Küpper owns $1,000. What is Scotiabank now doing is taking that $1,000, well, not all of the $1,000, but let's say 950, depending on the minimum reserve that the bank needs to hold, and gives that as credit to Trevor, because Trevor wants to start a business or wants to build a house or whatever. So now what happens? We now have almost tripled the amount of money that is circulating. I have $1,000 on my book when I look at my bank account. And the Trevor Forrest also has now not the whole 1,000, but almost $1,000 more, meaning we have just doubled the amount of money that is floating around. That is super oversimplified, but I think everybody is getting the idea. And that's basically how banks are earning a lot of their money, because they're taking short savings, meaning my money that I just parked in my bank account, and lend that out as a credit for a longer period of time for usually a higher interest rate than I get in my savings account. That's called maturity transformation, and that is how a bank makes money. That is also one of the reasons why we have inflation, because now we have more money in the system, but we do not necessarily have more products and services. So that's the system that we have today. And when we now introduce a central bank digital currency, from my understanding, no matter if it's on the blockchain or not, that's then more a technical and a security issue, we still have all the control in one entity. For example, if we take China as an example, where they already have digital currencies, that also comes with a lot of problems, because right now, if we have cash, I can buy and pay anybody that I want, as long, of course, you accept my cash and as long as we are in the same jurisdiction. But nobody can really prevent me from doing that. But if we have a digital currency, it would be, you could think of a scenario where now the central bank or the government or whoever says, no, that person is not allowed to buy that services with that digital currency, because now it's programmable. So I think that is a big problem when we're talking about free trade, maybe things, freedom of speech, when we're talking about, generally speaking, democracy, if you want to, because now, again, we have full control of one entity about the money of all participants in the market. So that's a big problem that I see with central bank digital currencies, but that's a problem that we already have in some way or form today. So on the other side, we then have the idea of decentralized finance, meaning Trevor, George, and we say, screw that. We build our own currency on the blockchain. We take a piece of paper and write down, I have now $100 of the STG currency when we just take our initials, and Trevor gets 100 and George gets 100. And we say, okay, I can now pay everybody that accepts that money for, again, goods and services. And because it's on the blockchain, I can verify every transaction, and we do not need a third or fourth party in that case as a bank that verifies the transactions and so on, meaning we are now completely independent from central banks, from governments, and so on. That's why I think most governments or most central banks do not really have an interest in like giving away that power, because if you now kind of combine that with real estate and other things that you can put on the blockchain, I could literally buy from Trevor or from George real estate in the respective country with a cryptocurrency, and nobody else would be involved, nobody else would knowing what we're doing, and nobody else could get tax income from that. So that is my understanding that I have right now. So when someone would ask me, what would you prefer? I honestly would prefer a decentralized finance system where I do not need banks, where I do not have one entity that has so much power. Honestly, I don't know if the current cryptocurrencies that we have can fulfill that need and can play that role. I think the technology is extremely promising and basically fulfills a lot of the criteria that I mentioned earlier: durability, portability, divisibility, uniformity, limited supply, and acceptability. I think the big problem today is acceptability, because you cannot pay everywhere in Bitcoin. You cannot go to your local shop and buy some banana or whatever with Bitcoin. That's not possible. So these are my thoughts basically about the current situation. So maybe we can talk a little about that, meaning about the idea of centralized finance and then decentralized finance. And you guys know way more about the technical side of that than I do.
Yeah. So again, a good encapsulation of the whole situation. But I'll say this, because most of us, everybody who is watching this, us in this talk, kind of born and grow in a particular system of doing things. We came and saw this. My father, my grandfather, this is the system that we have now is what they came and saw. They are not even prepared to entertain anything different. That is one of the reasons why what we're looking at with the new way of doing things, and when I say new way, decentralized way of doing things, is so mind-blowing, but it's also a huge concern, especially for governments and central bank, because everything that you described in what you've said represents systems of control.
Right.
Now, unfortunately, there are many people who have been programmed to believe that they need to have those systems of control. One, some people are not prone to that, so those are the people who don't keep their money in the bank; they keep it under them bed. But one of the challenges that you face, or one of the challenges that governments would face, is trying to determine how to maintain a certain degree of order in light of, some of these emerging new ways of doing things, right? So, one challenges we now have. So we see what's possible as people who understand the technology and so on. But one challenges we have is trying to understand now how people will adapt, buy into, accept these technologies, accept these very new ways of doing things. And I mean, I'll give you an example. It took me 2 years to get my mother, who was at the time in her late 60s, going on 70s, to go to an ATM machine and use a card to draw out money. Right? Now, if you use that as an example, which is a prevalent example in many parishes in Jamaica, countries in the Caribbean, and Central Latin America, where some people, because they have been inculcated in a particular way of doing things, it's very difficult for them to shift, which means it's very difficult for acceptance, which is one of the things that you spoke about, of a new system, because that new system, first and foremost, has to give them, comfort and trust, and the warm and fuzzies is what I normally say, that when I do a transaction with you, if I want to buy something from Simon, and this is again entirely in the digital space, if I want to buy something from Simon, when I send Simon the money, Simon sends me the good. And there must be a system of things in place that if I don't get the good that I purchased from Simon, I get my money back. Right. So I often say, like when I'm like, I give these lectures at universities about digital currency and cryptocurrency and so on, and well, typically blockchain. So, well, when you go and order something from Amazon, how do you know that you're going to get it? What's a guarantee? You don't know anything about Amazon. Like 90% of people have never even seen Amazon's offices, but they trust buying stuff from Amazon. People and an entity they don't know, right? They can't see. And the reason for that is there's a lot of stuff going on in between to sort of set up this guarantee that they'll get the thing they purchased, and who is selling it will get their money. Now, what's mind-blowing, which is why blockchain technology is just so fantastic to me, is how do you now take and replicate that without all of those people in the middle, or entities or touch points in the middle, and still maintain the warm and fuzzy based on what I'm used to? Because that's how you get adoption, right? So if you're going to tell me, oh, we're going to change the system, it needs to be something that I can appreciate, that I can feel comfortable with, and that I can feel confident that when I do a value exchange transaction, what I expect to happen will happen, right? And again, that kind of goes back to what George was saying. When you look at what blockchain is designed to do, it is perhaps the only thing that is capable right now of actually replicating that kind of scenario that we've been used to for centuries in an entirely digital way, right? So when you talk about now, I'm not going to be moving gold or paper money around, but I still want to make sure that when I go to the store, when I go to the restaurant, when I go to shop online, and I'm doing all of this in entirely a digital way, what happens in between, which is entirely digital, no middleman, no discretion, no control of some fiscal policy, this, that, and it. I control that, or we control that in the group. It needs to ensure that what I expect to happen happens, right? So that's the first thing. The last thing I want to say is one of the biggest challenges to adoption and implementation of systems like these is not the technology, but it is the people. Because governments, a lot of responsibilities put on governments by people, right? And people also tend to shirk their own responsibilities. They turn it over to governments every election to say, look, you need to go and do this for me. When you play in a decentralized space, responsibility shifts back to the citizen, right? Not every citizen wants the responsibility, right? Not every citizenry is sophisticated enough to accept that responsibility. So what you're going to find is you're going to have some people who really don't want to take on the responsibility that comes with being able to manage and exchange your own currency and do your transactions and so on, because I just don't want to do it. Right? I like the old way. Right? I like not having to worry about stuff. I like not having to worry about security. I mean, you have people who don't even want to worry about the password and how complex that has to be. So I say that to say that my view is you're not going to just have this jump from one modality to another. What I actually think is going to happen and has to happen is that you're going to start to see, and what must happen, is that you're going to start to see a hybridization of what we know as the currency system, where digital currencies, cryptocurrencies, virtual currencies, the whole, gamut of, what is digital currencies, will have to start to, people have to start to get comfortable with it. I mean, the only reason why central banks started to investigate their own central bank digital currencies because of the disruption of cryptocurrencies and what that was causing, because too many people were starting to say, oh, look, this looks like an interesting way of doing stuff. And just like George says, the reason why these things become appealing is because of the central bank, the commercial banks not doing things in an efficient way, right? Not innovating enough and staying up with the times. So I think there's going to be a hybridization because people have to start to understand and get comfortable with this new way. It takes time, but it has started. And once they start to get comfortable, I think you'll start to see a movement away from the traditional, but people starting to now think about these new ways. So the traditional status quo that central banks, commercial banks, and the advent of central bank digital currencies brings in will fundamentally be challenged. They will still exist. They have to, because there has to be a transition, but now they're being challenged because there are now new ways, new technologies about which we can think to do new transactions. Post offices still exist, right? But people use email now. It's just that the role of post offices has changed. It has evolved. They just didn't go away, but now more people use email, right? I think the same thing will happen over time eventually, and the internet did that, by the way. More things will evolve over time, in the same way we saw the information exchange evolve. And I think that as people start to get comfortable with this new modality, you start to see greater and greater acceptance. But the underlying thing is we have a technology today that will facilitate this kind of movement. And I think that blockchain represents the ability to move in that direction. Right? That's my more than 2 cents.
All right, George, your thoughts, and then we jump in some of the comments.
That's a lot to unpack there. There's I agree with a lot of the points that Trevor is making, but let me just sort of break it down from the points you made up first, Simon. Number one, let me talk about centralized and decentralized. Decentralized platforms or decentralized movement of money are ideal, but it's a nightmare for a government who is trying to run an economy. For some simple reasons. Governments need to earn taxes on transactions. If you can't collect your GST on transactions because you can't audit those transactions, then you can't collect your GST and you have a tax revenue issue.
Can't fix the road.
Exactly. If you can't collect funds on freight and duties for goods delivered, etc., then you have a problem. If you can't tax transactions or income, you have a problem. So there is no way that it's a central government that makes any income on transactions being done is going to give up or should give up being able to see the size of the economy that it runs, obviously, and then able to make its capital plans based on the budgets associated with all the variables in the equation. That's number one. And we don't expect them to give that up. Okay? Number two. So there should be no expectation that any government is going to give up tax.
Yeah, let's be realistic. That's true.
Okay. So, number two, we have what we call gray economies and black economies in every single market. There are proceeds from criminal transactions that the government will never see. And it moves primarily in cash. So you have fiat transactions that are going around for criminal transactions. And then you have those individuals who are not criminals, but we call the gray market, who don't have bank accounts, who have no financial digital footprint of any kind. You don't know if they're making $1 or $1 billion, because everything they do in cash. You could be a carpenter, an electrician who gets paid in cash, buys everything in cash, services in cash, no financial trail at all. So those are situations where, for a government, a CBDC makes sense. And I would encourage any government, and I know that there's a lot of discussion in Jamaica about privacy of transactions, about KYC, about who holds the wallet, who doesn't hold the wallet, about allowing commercial banks to have access to the wallets, etc. I am in no position to tell anyone how to run their economy or do their business, or if to include or exclude commercial banks and others. But I know that every single citizen that's in a country, usually, particularly in developing countries now, usually have an ID card of some kind, a driver's license of some kind, passports, not so much, but a voter's card in some instances, a birth certificate in some instances, and they use some type of government service at some time. Good. So the government has a pretty good idea of the total number of citizens in working age in its economy. When we were discussing CBDCs with other commercial banks, other central banks, one of the things we said is that the central bank should be the holder of the wallet. And for those who may not be aware, in order for digital currencies to move, it begins with ID. So every user, regardless of the user as an individual or a corporation, must have an ID. And then that ID is associated with a wallet, a digital wallet. Whatever fiat they have is then put in the digital wallet, and the exchange happens wallet to wallet, peer to peer. And settlement is managed by the central bank or whichever entity they empower to do the settlement. Right now, the process for settlement for most banking systems is that commercial bank A, commercial bank B, and the central bank in between. So there's interbank settlement, but the funds are usually held in the settlement account at the central bank, and then at the end of the day, the debits and the credits are netted off. What a CBDC does, it eliminates that process. The central bank is the only entity involved, the wallets are peer-to-peer, and the settlement is done almost immediately. I have to say that Jamaica has led in this space, because back in 2012, there was ACH for business-to-business transactions managed by the central bank. Okay. Where commercial banks don't have to be involved at all, you just set up your accounts, and you're able to move funds from business to business directly over the central bank platform. And I think there's still All we've done is taken this process now and made it available so that citizens can also carry out the same transaction. So the guy who's selling bread at the side of the street or the donuts as you drive down halfway through the road, he now has a mobile phone, if he does have a mobile phone, and you have one, and you just tap, currency is transferred, and you go. And we can speak about how that works by QR code, or how that works by a barcode, or how that works by NFC in the phones, etc. And in the absence of those people who don't have smartphones, there's always a card that can be issued, a generic type card, where you can tap for small transactions. Now, one of the things that we spoke about was trust and adoption. This is a huge thing, because most people believe that cryptocurrency is a method for payments to be made in the dark of night. Okay? And therefore, it is used primarily by those persons who have nefarious intent. Absolutely incorrect. More cash is used by criminals than cryptocurrency. Cryptocurrencies can be tracked, etc., just like anything else. What I will say is that adoption has to come back to the hybrid system that Trevor spoke to. Because government is the only real entity in any country that can offer ubiquity and can offer guidelines for regulations where they say that everyone must have an account. And then, if it's peer-to-peer first, small transactions to drive trust and adoption, that will then yield results as you go on. Now, the next thing is risk, which is what we spoke to earlier as well. Now, when I put $100 on my debit card or credit card, I know that Scotiabank, CIBC, whatever, is going to try to protect, in inverted commas, my money to some extent. And the point that Trevor made about, am I going to get goods for the cash that I've paid? Now, with that risk process, again, small transactions, central bank being the regulator, will drive a lot more adoption. And then as it becomes understood how this works, how simple it is to use, I think we get greater adoption going forward. But I think that central bank regulation, in terms of saying, I am the body that's holding all of the wallets, but you can pay the vendor on the street, you can pay the supermarket, etc. That's good. And then where commercial banks come in is when we move from fiat to crypto, where I can buy either through any commercial bank, the CBDC, and then load those funds onto the wallet and then have them for use. That's where we can get greater adoption. Now, when we talk to business transactions and having a trustless environment like what Trev spoke to earlier, smart contracts come into play. Where, for instance, think of a letter of credit as it stands today. A letter of credit is usually a business transaction where the buyer doesn't trust the seller. I don't know you, I want the product, but I don't trust you. Okay? So what do? I use a bank as an intermediary, and I give the bank a set of guidelines by which to pay the seller once they fulfill the agreements that we have in place. That's agreed. My funds are then held by the bank, including huge fees for the process. And only when the seller ticks each box does the bank go through and audit the process. And if I say goods received in good order, then the final payment is made. That's how. But a smart contract is an algorithm-based agreement that automatically, with the use of AI, to ensure that what's being done is actually done, so it's actualized, to manage that process. And I think that is something that commercial banks, instead of scoffing at, should sort of embrace, because it would make their process a lot more transparent. It'll make their process faster. It'll make their process cheaper. Okay, they can reduce the fee to the client. They can manage the process faster and put a great amount of trust, because all the stakeholders can be involved in seeing the documents as they go through the workflow. So decentralization, I think, is something that we should understand, but I don't think for developing and emerging economies that you're going to see wide adoption, because the trust level is so low right now. Okay? And we talk about the United States. Miami launched a digital currency last week, their own digital currency. So the city of Miami, in driving for adoption of this, has launched their regulated digital currency. We're going to see this roll out as we go forward, but trust will always be the thing that underpins how quickly we get adoption and how quickly we get uptake. And I just want to make another point on one particular thing as a national security issue. And I'm going to throw this one for territories, particularly in the Caribbean. Now, we have seen the contraction of Scotiabank in recent years, where they've sold off operations they have in some Caribbean territories in CARICOM. We've seen CIBC do the same thing. We've actually seen CIBC attempt to sell their entire regional operation to a Colombian conglomerate, and that was not upheld by the regulators. And FCIB, as it stands today, if you would remember, is because Barclays Bank retreated from the region. And then the amalgamation of CIBC and Barclays Bank became FCIB. So what are we seeing? And let's look down the road. We are seeing Canadian commercial banks, which really own the banking space in the region, retreat from the market because we're difficult, we're small, the fees are the highest in the world, but still they don't provide enough income as to what they could do in major markets. And this will continue. How do we, as developed, independent, small island states, how do we secure our financial process? The only way we can do that is by having at least the local transactions that we do be managed by local entities. Almost all the commercial banks in the region now have done away with local exchanges handling their debit card transactions. They have now farmed it out to Visa debit and MasterCard debit. That means that every local transaction, when I go to the corner shop to buy bread, my transaction goes to the US or Miami or wherever first. They take their fees, then comes back to me, and their fees are out of it. So the fee structure is now completely out of whack in terms of that process. And none of that money is staying with local operators. That's a risk. And I think we need to look at a black swan event because we have no control over them. Haiti is an example of that, with earthquake and a tropical storm, one on top of the other. Soufrière volcano in Kingston, St. Vincent, another black swan event. What's going to happen next? And what we've done is that we've farmed out our domestic fiscal policy or domestic fiscal process. And I think central banks and leaders in the industry need to look inward. How can I control this and manage this so that my local movement of currency, at least, I have some control over?
And I just want to interject something there, George and Simon, about that very specific point, because it's a very important point, and there are many proponents, schools of thought as it relates to farming out, how our transactions and so on are managed. But funnily enough, if implemented correctly, and let me say this again, if implemented correctly, central bank digital currencies will have a profound effect on the retail payment environment as we know it, which lends itself to a solution to that kind of problem that George is talking about. Because right now, payment systems, all the payment rails are really monopolized by the commercial banks, right? And again, this is what causes people to get frustrated with the efficiencies of doing transactions. I mean, it for the past 15, 20 years, it's been a chore to set up an e-commerce store for a business in Jamaica and get transactions to occur in a frictionless way without employing something like PayPal, because the banks just never lend themselves to facilitating, frictionless e-commerce payments, right? It's really just since COVID that the energy has jumped through the roof with commercial banks to do it. I have solutions all over the place now. Now, these things existed long time ago, but it's just now, thank God for COVID, that they're investing in these things and so on. But the thing with central bank digital currency is because of how it works, and how George, eloquently outlined it, it creates an opportunity now for entirely new payment solutions to emerge, which lends itself to a possible solution to that very problem that George just spoke to. Because, think about it. Every time you use your Visa debit, right, in Jamaica, that is not a local company processing that. Visa must get their pound of flesh. MasterCard must get their pound of flesh. And that pound of flesh does not stay local, right? So it is one of the interesting aspects of CBDC that I think governments should really pay close attention to. But I just wanted to stick that in there because it's one of the pros of CBDCs that I think we should pay close attention to, because when we don't keep the money local, then it affects us in very interesting ways, right? Because the same money that we didn't keep local is the same money that multilaterals come back and give us. So if you want to think of that vicious cycle, they're giving us back our own money and charging us for it.
Yeah, I think there were a lot of really, really good points, and I think we can come back to them in a second. I just want to make sure that we catch up with all the comments and all the questions that we got, because they are literally piling up and piling up and piling up. So I want to jump into that really quick. For everybody watching, listening, if you enjoyed so far, get the likes up, put your questions in the comment section. We try to get there now. So I've tried to bundle them a little bit together because I think a lot of the questions are kind of related. So Dominic Hart is asking, what is the benefit of a digital currency without blockchain? And two similar questions are from Bobo Dread on YouTube. Why does a digital currency need a blockchain? And then from LinkedIn again, from Jason, I'm eager to find out why the CBDC was not implemented on the blockchain. I think these three questions kind of have the same core. So maybe we can try to answer them first.
Yeah, so that's always been That's always been a question and concern for many of us, especially one blockchain enthusiasts or blockchain practitioners who view that technology as something that is critically important to moving in that direction. Now, what it boils down to is it's a particular choice and school of thought. So let me explain. And Simon, earlier I sent you a couple of links to some interesting
sources. Yeah.
Thoughts on that. But what you find is, first of all, blockchain is very good at doing certain things. There are some things it's not good at doing. Now, you can make the case for blockchain being the ideal technology for any digital currency. And somebody could make a case against it. Now, here's the thing. You have certain things that must occur when you're doing central bank digital currencies, because when you think about central bank digital currencies, there are a lot of factors that come into play over and above what happens when you're talking about just cryptocurrencies, right? Centralized versus decentralized means control versus no control, warm and fuzzy versus risky. The ability to transition, because you can't jump from one to the other and expect everybody to be okay. Now, some entities decide that they want to. Oh, and the other thing is, blockchain technology amounts to what's a very secure and sophisticated ledger of transactions, right? Now, one thing some people don't realize is that while blockchain technology is technically a distributed ledger, because that's how it's designed, right? And what that means is that all of the transactions are stored in a ledger, which is the database, so to speak. And that database exists on every peer in the blockchain network. And all the transactions that occur are verified and validated using a consensus algorithm that does some very sophisticated and exciting stuff to create and validate that transaction in a very unique way, in a very immutable way, so that security and so on exists. Now, one thing that some people don't realize is that not all distributed ledgers are blockchains. So you can actually have distributed ledger technology that is not blockchain, right? So that's something to consider. The other thing to consider also is the fact that blockchain uses particular cryptographic methods to do what it does in order to secure the end-to-end transaction process that occurs. But again, there are some schools of thought that say, well, I don't need blockchain to use this type of cryptographic process to secure a transaction. That is now where we start to have differences of opinion, right? So what you'll find is that there are some entities that say, well, we don't need to use blockchain. We just need to use something that conforms to these particular things that really amounts to what blockchain does anyway, but conforms to these things, but at the same time allows us to integrate and transition from traditional archaic systems and move into a new realm. And I think that is where some entities have a challenge, or sorry, not a challenge, it's deliberate, where they are saying we're digitizing a traditional system in such a way that when we transition, we maintain the same the status quo, so to speak, with limited disruption. And in their view, you cannot accomplish that with blockchain technology, because in their mind it's almost as if you're doing lift and drop over here, and that represents major challenges. And again, that is where we start to have differences of opinion as to why blockchain technology cannot be used. The other thing that comes into play, and again, misconceptions, but it is what it is the question about privacy of information. Now, one of the things about blockchain is that when transactions are written to the blockchain, that ledger, they're immutable, which means you can't change them. You can't remove transactions from the chain. And it's by nature of how blockchain works. It was designed to work that way. So what you'll start hearing is arguments about privacy, where, well, suppose there's information that's on the chain that I don't want there anymore, as a citizen, perhaps. How do I get it off? When law says that, oh, you know, this, I have a, you know, data protection laws or GDPR or anything like that says that, oh, I have a right to tell you how to treat with my data. How do I get my data off of the blockchain when what's on the blockchain is immutable? All right. Again, those cases are normally made, but it's not entirely accurate, because you have a thing called on-chain and off-chain data and information. And it goes back to how you design the blockchain platform that you choose to use, because you can architect blockchain platforms to ensure that any data currently or in the future that could be viewed as perishable or so on does not exist on the chain, right? So you can design blockchain platforms that only track transactions and nothing else, right? But it is what the technology itself facilitates that is really important. So what it boils down to really for the question there is that was the questions about why blockchain technology wasn't used. It's really a choice, a school of thought that some entities and solutions providers have. That's like, you know, why do you use Windows and not Linux? You know what I mean? Why do you use Mac OS? That kind of stuff. For the most part, they do the same thing, but some do it in a different way. Some do it better, some do it more secure, and so on. And that's really what it boils down to. Now, personally, I asked the question because because of what blockchain was meant to do, I would get the warm and fuzzies much easier if these CBDC platforms employed blockchain. But that's based on my knowledge and view of how blockchain works, what it does, what it's capable of, and so on. There is also one other point that was brought up by, again, another school of thought, that blockchain is not the most suitable technology for minting currency. While it is good for tracking transactions and so on and so forth, for minting currency that has to function in such a way that, you know, it's almost like the digital twin of paper and has certain characteristics, blockchain isn't the most suitable for that. Again, varying schools of thought. It's always up for debate and conversation, but it's really boils down to a choice. And the choice has to be based on some check boxes that exist. And one of the things that I am pretty certain of is that if you put a blockchain platform and any other platform used for CBDCs together, the check boxes that pop off from a technical standpoint, I think that ought to be checked. But you find that, again, there are some other mitigating factors that come into play that cause some of these decisions to be made. And of course, there is the salesman aspect. If you make the most compelling case for your platform or technology, you get the win.
I think that ties in very well for the next question, and I think George, this one is perfectly for you. We have so many questions that I want to make sure that we can get to all of them, but maybe we can keep the answers like for 1 or 2 minutes just to make sure that we can get to all the points. Another question is, I'm curious why the Jamaican Central Bank chose an Irish tech company instead of a company already on the market. What made them not believe that, for example, One Ledger could deliver the service? And we actually talked about that before the live stream off camera and ask ourselves, that company that did that actually for the first time? And how trustworthy is the whole process? So maybe, George, you can answer this question.
It's a competitive bid.
Well, this sort of segues from the first question. I mean, if you're not going to use blockchain, then you wouldn't engage a blockchain firm.
Quick and easy.
It was a competitive bid, but
if you're going to use a CBDC with no blockchain underpinning it, then you don't need a blockchain company for that. You can use any tech company to build you a database that moves ones and zeros. Now, I'm going to try to make this brief. I mean, blockchain and cryptocurrency are two different animals, as Trevor was just saying. All right, so that's like saying that Excel is spreadsheets. It's not the same thing at all. So blockchain offers, and there are 5 things, and I want everyone listening to remember these 5 things. I want to quiz you on it afterwards. So blockchain offers 5 unique characteristics for transactions. One is immutability. Trevor mentioned that, which means that simply once a transaction is written to the database, it cannot be changed. All right? And it cannot be changed without consensus from everyone in the group. But even when you change it, there is no change. You create another hash transaction that shows that you changed it. Decentralization. There's no single point of failure on blockchain. Most databases, by their nature, have a single point of failure. And that's why some companies are hacked. Central exchanges are hacked because there's one point of failure. If I can either get a latency issue or I can get an attack on your system, then you have a central point of failure that can impact your ability to move. Blockchain has a decentralized architecture and is a distributed database. Transparency. Everyone who's a stakeholder can see the transaction, when it was initiated, when it was occurred, when it was out, point of origination, point of destination, where you originally got the funds from, et cetera, et cetera. Everyone can see that. That's sort of transparency. So auditors and assurance personnel who are on the call should prick their ears and understand that they can now audit remotely by having access to transactions on the blockchain. Pseudonymity. My transactions could be done as G41 or GS or ABC. And only anyone who controls the exchange would know my real identity. That's another thing. Chronology. Obviously, every transaction is timestamped and can be traced back. But that is not unique to the blockchain. Most other applications where changes are made, that happens as well. So why would the government of Jamaica choose to do a transaction like this without the blockchain? And then use terms like minting. Minting is primarily a blockchain term, okay? Especially as we know it now. But there are ways to manage blockchain transactions. Proof of work is what most people do. Proof of work means that when you create the algorithm to mint $1 or to mint any currency, someone has to solve that. And usually you would hear that there are miners who get significant fees for having to solve this and mint the data. Proof of work is becoming old school because of the energy burn and because of the fees associated with it. There are 14-year-olds who are becoming millionaires because they spend most of their time at home minting on a gaming system. So central banks, others should use proof of stake, okay, which is just a consensus system. All the holders of the main currency will make a determination. We want to mint X amount of currency. As long as you get 2/3 saying yes, it's minted. There are no additional fees. It reduces the fee structure to decimal points. It reduces utility costs in country to decimal points. And then we come back to the age-old issue of why would they choose an Irish firm? There is, throughout CARICOM and throughout a lot of developing countries, that companies, individuals, etc., who operate in emerging spaces in their countries or domiciled in their countries don't have the scale, the capacity, the aptitude, the skill sets to deliver. So one of the things that we have done in the Caribbean, I mean, even though One Ledger is based both in Barbados and Canada, we make most of our pitches globally. Because for some reason, we get much more traction with global pitches than we do with local or regional pitches. That is something that we need to look within ourselves as Caribbean people and really think about. Because there is no way that a company in Ireland would forego an Irish firm who is even experimenting in space and choose a firm from the region to do it. But we are fundamentally challenged to allow local, regional firms to step up and show what they can do. So we have to prove ourselves outside the region and globally first, and then perhaps we'll be able to have local dialogue that would lead to a meaningful exchange.
So back to the question, why, or to the original question.
So to answer that question,
it's not on the blockchain. I think that is the quick answer.
Right. So but in all fairness, to answer that question, they did put out an RFP, so it was a competitive bid process. But again, I would say it's who made the most compelling case. And like I said, so if a wise man told me one time, if I'm a salesman and I'm trying to sell you something and you don't buy, it's my fault. So I would say that who won that bid made the most compelling case, and it turns out that the most compelling case does not use blockchain.
Okay, let's move on to the next questions, and I think they're kind of related. So Justine is asking, I agree with Jason. What does the panel have to say about the view that the CBDC is just a rebranded RTGS clearance system, no different from what we have now? And I think that ties good into the next question. From the customer's perspective, is CBDC yet another bank account? If so, then why would persons use it? Or is it a new settlement layer that commercial banks can use to send funds instantly? And then maybe the follow-up question from Justine, why did the Bank of Jamaica not use blockchain when most other CBDC in the Caribbean use blockchain, like Eastern Caribbean? So I hope that wasn't too much, but I think we get the underlying question here.
Let me jump in here first, Trevor, if you don't mind.
Sure.
The thing with RTGS, which is a platform that's been around for some time, the difference between RTGS and a blockchain on a CBDC is that I can't use RTGS on a mobile platform. You have to log into, as far as I know, I don't know if that's changed now. You have to log into the government system and be able to do it. You can't use QR code and payment apps that underpin it to easily do peer-to-peer transactions. So it's not set up to do peer-to-peer, normal, everyday consumer-based transactions. while the blockchain is set up to do everything from both large B2B to small P2P transaction. That's the simple answer, I think, in my mind on that one. And I think that there's a lack of trust in terms of what regional companies can do. The Eastern Caribbean Central Bank digital currency that BIT has used as a project doesn't have adoption. They're now trying to trade it and use it as an investment tool. But in terms of adoption being used in a consumer cycle, it's not. And I think that's something that we need to address. But the central bank can make a determination that they will issue wallets to everyone and then drive the marketing and everything else around it. But until that is done, because we don't have challenges like, say, Nigeria and Ghana who use M-Pesa, okay, or Uber in order to do their transactions, we don't have a history of doing digital transactions for consumer-based stuff on a mobile phone. So there's still a long way we need to go in terms of education in order to drive adoption.
I wanted to, and Simon, if you could put back up that question, I think it was from
this one.
No, not that one. Yes, this one here. So technically, what CBDC will facilitate is a situation where you actually don't need a bank account. And George had spoke to how that actually happens, where you're doing transactions between the wallets, and that's where the movement of the currency occurs, which negates the need for what you would look at as a traditional bank account, because now you're storing the asset in your digital wallet. So I think perhaps you could say it's more closer to a new settlement layer, so to speak. The thing about it is, which George alluded to, but I don't think everybody might have gotten it, is depending on how you implement this thing, it can remove the need for a commercial bank. Now, that's not how our central bank is doing it, but it does have the potential to remove the need for commercial banks. Right now, what the advent of CBDCs will do is it's going to cause commercial banks to have, they need to start getting a little more creative and innovative and so on, because now a lot of what gives them their revenue, which is fees, right? We got tremendous amount of money on fees. They don't have an excuse for that anymore, because what the fee structure was predicated on will technically no longer exist. So that's one thing, but also the competition in payment solutions, retail payment solutions, that environment that ought to be created by CBDCs will now facilitate more innovative payment solutions. So the monopoly that exists between commercial banks now as it relates to retail payment, the hope is that greater competition, lower cost payment solutions will come to the fore. To answer the question as to why blockchain wasn't used again, I have to say, you see, one of the things is the people who understand and know blockchain, it makes sense to us already. Problem we have is we don't articulate to the people who don't know or understand it. And if I go into a room with a bunch of people who are inextricably tied to traditional systems and I can't explain it in their terms so that it makes sense for them, the guy who comes in and explains his system in terms that they understand and says, oh, by the way, it's all digital, wins. So simple as that. So understand that you have to, and we don't do enough education. So I enjoy doing stuff like this, and really want to thank you, Simon, for for bringing myself and George and promoting this kind of discussion, because we don't talk about it enough, right? And because we don't talk about it enough is the reason why there is no belief that anybody in the local scene even has a clue. So what do? We go overseas, right? So one of the things we need to do in the local context as well is talk about it, educate, have more discussions like this, because it does a couple of things. It educates people, but it also lets people know that there's knowledge on the ground locally about this stuff, right? So that's very important, because it helps people to develop some confidence that we actually know what we're talking about, even though we're in the local space. So that's something that is very important. And you know, we have to have that discussion more. We have to educate people more about the technology. I'm not sure we're doing enough of that. And once we do that, I think you might see a little shift in you know.
Let me just give a real world example here before we go on to another question. So look, any merchant who's listening to this, I'm sure that at your retail store, you've got at least one or two point of sale devices.
Yeah.
Okay.
Yes.
That point of sale device, merchants have to pay the banks a rental fee for it. It's the first thing. Okay. Number two, when the transaction is done, debit or credit, I'm not sure in some jurisdictions it's immediate. Some jurisdictions you have to wait overnight to get your funds, and the bank takes their charges out first. Okay. With a digital CBDC, just imagine not having any devices on your counter, unless you want a mobile phone or some scanner, and then your funds are in your account for you to use immediately. And the charge goes from the 5%, 10%, 20%, whatever you're being paid, to fractions of cents for each transaction. That's where it makes a critical difference. Absolutely. And that's why commercial banks may be not open to accepting it as well, because their fee structure on the point of sale business is now under threat.
Absolutely.
So if a private firm were able to offer that as a means of settlement,
absolutely,
for B2C, immediate, significant reduction in fees, right? So your cash flow is completely changed. You don't have to go and check your account overnight and hope and pray that you have enough tomorrow to start the cycle all over again. So the immediacy of it is the thing. And that's a real world example that you can look at.
There is also a catch-22 with that, because, like I said before, commercial banks now have to get more innovative, because their fee structure and the payment system and ecosystem will change. But here's the thing now. Here's one of the catch-22s, because they're notoriously lazy, right? If they lose money in one area, they're going to seek to recoup it in another. So what you might find is interest rates on home loans or car loans or the easy stuff that they control. You start to see interest rates on these things go up, as opposed to creating new products that can generate new revenue streams in this new modality, right? So these are these are some of those trade-offs, which makes this thing so dynamic, and because there's so many factors at play, that it's not as simple as saying, oh well, because blockchain works and it's great and so on. The reality is that in making the case for this wonderful technology, you have to consider all of the factors that are at play and make the viable case for what we're doing. And I don't think we do enough of that in the most effective way, right? I mean, it's the same problem that us as technology practitioners have. When we're talking to clients, we sound like gibberish, but it already makes sense to us. Why doesn't it make sense to you? and that's our fault. We have to make it make sense if we expect them to adopt it. And it's not only to the banks and the financial institutions. After a while, a couple of people, the main stakeholders, have to understand it as well. Now, what you really want to happen, and this is when I view, when people say, well, people ask me, so when do you know that blockchain has really made an impact or has made it? And my answer to that question is when people stop calling it blockchain or stop talking about it. So what happens is you're using things that are sitting on top of blockchain, and you don't even know it's blockchain behind it. And that's when blockchain technology has arrived. Because, and again, I use the corollary, nobody talks about TCP/IP, but there would be no internet without it.
Right.
Right. So yeah, that's kind of, but there's so many factors at play, which makes this stuff so exciting. That we have to take those kinds of things into consideration.
Yeah, I think one of the big challenges, as you said, to communicate this sometimes very complex systems or ideas in a way that everybody can understand it, or to understand the practical use case at the end of the day. I think that question kind of ties in nicely from Bobo Dread again. 70% of Jamaicans do not use banks, but they all have mobile phones. But they benefit from a centralized digital currency or a decentralized cryptocurrency. And I think we kind of answered that question right now a little bit, but maybe you can give a short answer to that.
Yeah, that number is not entirely accurate. It's less than 70%, but it's
very optimistic number there.
Yeah, it's less than 70%, but the number is still high. Yeah, you see, the thing is, the reason why a lot of people don't use the bank is because a trust problem. A lot of them don't trust it. In fact, you have people who have bank accounts but don't use the bank, right? You have people who even if they have the money in the bank, they go to the bank every couple of days to ask them to show me the money, right? No, and it really boils down to a trust thing, which is where the adoption part comes in. Now, with CBDCs, I think, again, and I always preface it by saying, if implemented properly, would not require people to have that traditional bank account, right? Because the way it is meant to work, because it is mimicking what crypto and blockchain and Bitcoin was meant to solve, but trying to put it into a regulated and centralized space. But once you move into that space, the way it works does not require you to have a bank account, because all you're doing is moving currency from point A to point B, which happens to be from one person wallet to another. So think about taking money out of your wallet and just putting it into somebody else's wallet and then giving you a particular good or service and so on. So that's what the concept of CBDC is meant to accomplish, which is why you'll hear them say, oh, we expect greater inclusion, the fancy terms they use, in the financial system, because it removes some of those things that people view as a hindrance or things that people don't trust, which is, again, slightly different from crypto, because crypto, the difference between CBDCs and cryptocurrencies is that CBDCs are backed by central banks, regulated and considered legal tender. Generally cryptocurrencies are not considered legal tender, so you can't go anywhere and use it. The CBDC is really, like I said, the digital twin of the paper money, so you can go anywhere and use it. So that I hope that kind of answers that question. There, the people who don't use banks will kind of move into the financial system, but they don't need bank accounts, so to speak. Which is why I say the role of a commercial bank will need to evolve um, in the future because of how this kind of stuff works.
So let me just jump in here for a minute before we go
Yeah,
on
sure.
to that one.
Go ahead.
You see, if commercial banks were effective at their jobs, the adoption rate for commercial banks wouldn't be so low.
Mm-hmm.
Unless you live in Kingston, unless you're one of the 500,000 people who live in Kingston, 1 through 10, doing a transaction at a commercial bank is really a hassle. It's inconvenient.
Yeah.
They're few and far apart. ATMs are few and far apart. And a lot of the trade that's done is not through established business operations. Okay. So that's why cash comes into play so much in Jamaica, because of the vast size of the country, et cetera, and how people are spread out. A CBDC solves that problem, regardless if it's crypto based or not. Because most people have a mobile phone, but most don't have smartphones. So we've got a lot of mobile phones, we don't have a lot of smartphones. So the application can sit on a mobile phone if it's a smartphone. If it's not, you need some other means to access it. So the merchants would have to have a smartphone at least. And then those who don't would have to have a kind of card that allows them to interact with it, whatever that card is, whatever the modality is that they use. Because Digicel in Jamaica, more than 70% of their clients are what you call pay-as-you-go. So it means they don't have mobile accounts. They load cash onto the card, onto their phones as required. If those vendors can manage loading funds onto the wallet in the same way initially, you'll see adoption rates go up.
Absolutely.
Right? And you'll see a wider use. But the ubiquity that comes with having a tool that allows me to trade with unestablished businesses is where you will get greater adoption, right? And greater trust with a CBDC.
There is one big thing we haven't touched on, Simon, if you would indulge me. A big thing that we have to pay attention to ensure success, trust, adoption, and so on of any sort of digital currency is the fact that this stuff, for it to function, requires infrastructure. When I say infrastructure, I mean networks that are robust, resilient, and secure. Now, across the Caribbean, and I mean, the Caribbean is beholden to two providers in most places, which is cable and wireless, aka Flow, aka many things depending on the country, the region you go to, and Digicel. And one of the things that is a key tenet of CBDCs and digital currencies in general, if they are to work and be trusted, is the transactions must be able to occur, even if the infrastructure that is required to make the transaction work is not available. So offline transactions is a very important thing. It's often overlooked. So think about, when you go to a vendor and they say, oh boy, I can't use the swipe machine or the point of sale machine because the network is down. If you don't have cash, you can't buy that thing that you want because you're walking around with something that depends on a network, and the network is down. So now what do I do? Well, go to the ATM and draw some cash. And so the infrastructure, whether it be wireless, fiber, whatever, is a critical component of digital currency systems working, the reliability of that. And that is always in question in our jurisdictions because the reliability of our data networks is always in question. The second thing, which is often again overlooked, is there can be no data network without power. And if you don't have reliable power grids, again, you will have problems and concerns. Now, why do I highlight these things? Because many of the countries in our region sit in, hurricane belts. And there are times of year when things happen that threaten these very components, this infrastructure, right? And we have to consider that as we move down this path, that we have to make sure that the infrastructure is reliable and resilient. Because when you're gone fully digital, you can't run to the bank and pull out $50,000 when you hear the hurricane coming, so that when you need to go out on the road and buy stuff, you have cash, right? So these are some of the other things we have to consider because of our realities that we have to deal with. So again, I just want to, and I say these things because this is the stuff that we have to consider when we're making our case for our technology to work, right? So I just wanted to put that out there as well.
Yeah, and I think when it comes to adoption, one of the questions that I see not only popping up in the chat over and over again is the question for security. So I just bring up the one from Giovanni here. My question is more on security. How secure would be the CBDC as opposed to cryptocurrency, especially seeing that there was a major cryptocurrency theft the other day? And just to everybody in the chat, we try to get to all the questions. I fear, because of for time reasons, we will not be able to make it. But nonetheless, keep the questions coming, and if they are not already answered, I try to bring them up. So gentlemen, what would you say regards the security question that again pops up in one or another form often? And I think it's tied back to what you said earlier on, that a lot of people have a problem to grasp or wrap their head around the whole concept, and therefore are kind of hesitant. And the security question is, I think, a big one for a lot of people.
Let me jump in here first. Yeah, let me jump in here first in terms of security.
Sure.
The cryptocurrency theft that happened recently was because it was a centralized exchange. If it were a decentralized exchange, you could never have that occurring, because all of the users would have to give consent to the hacker to get into their system. So centralized platforms, no matter how secure you try to make them, as long as there's a single point of failure, it's gonna be an issue. So you can put this CBDC, as you are now, on a centralized server, and there's a security risk. If it were a cryptocurrency in a regular decentralized platform, that risk would be mitigated significantly. So my thing is, the little that I know about cryptocurrencies is that once they're in a decentralized platform, that the ability of anyone to hack that platform and take funds is significantly reduced. You would have to compromise every single major node. They actually take over the whole exchange first, before you're able to get anything out of it. And even when you do, the minute that an unauthorized transaction happens,
everybody knows.
Everybody knows, and you're shut down. So that happens with a decentralized platform, which cryptocurrency offers. If you then put your crypto on a centralized platform, you open up yourself to risk.
So just to speak a little bit more about the technical aspects of crypto and decentralized platform and the security, it's very difficult to, because of the nature of how blockchain works, it's very difficult to compromise and hack, but it is not to say that it is not hackable. There are unique situations where compromise can occur. And George just spoke to it. I'll give you the official term, where they call it the 51% dilemma, right? And That is one of the perhaps only concerns that outside of faulty code and smart contracts that people have, especially architects and so on, in using the technology. So let me explain what that security concern amounts to. The transactions are on the network are validated based on a consensus mechanism, right? Now, on that network, you have hundreds, thousands of devices that are all communicating with a copy of the ledger that says, look, is this transaction valid? Do we all agree that this transaction is valid? Should we allow it to happen? Everybody says, well, the majority of people say yes, or machines say yes. Transaction is valid, block gets created, added to the chain. What's next? Now, if a single entity controlled 51% of the devices on that network, that entity could influence, obviously, the decision that amounts to consensus. And if you're able to do that, then you're able to control what transactions are validated and approved and which ones are not. Now, if you can do that, then you can set up transactions that allow you to extract money or value out of that network. So what you always want to do is to ensure that if it is a private blockchain, because you have various types of blockchain, you have private, public, federated, and hybrids. What you always want to make sure to increase the level of security to a point where it's extremely difficult to hack is to make sure that no one entity controls over 50% of the nodes on that network. If you ever find a blockchain or cryptocurrency network where that exists, stay away from it. All right, because that is a questionable scenario. So anything in the digital space is susceptible to security concerns and issues. What you want to do is ensure that you take all the measures to best mitigate it. Hacking of the blockchain itself is a virtual impossibility, but it is the platforms that they exist on and how that particular blockchain platform or even CBDC platform is designed, built, tested, and secured that is important, right? So you kind of want to pay attention to that. So to answer the question, the securities of CBDC networks or cryptocurrency networks can be extremely good, but they can also be extremely bad. It is how it is implemented and how the security mechanisms are implemented. And this is the case with any environment in the digital space. Oh, you're muted.
Sorry for that. I just want to add my 2 cents here because I think it's important to understand whenever we talk about security, what type of security or what type of risk are we talking about? For example, when we talk about cash, there is the risk that you lose your cash and nobody will give it back to you. That also can happen to you when you have your cryptocurrency in a cold storage on a USB stick, you lose that stick, then your money is gone. Right. I think when we need to understand the different layers of security. So for example, let's get back to the blockchain cryptocurrency that Trevor, George, and I created early on in our virtual scenario. And everybody of us would have a folder in paper, or in that case, digital, where we have written down who has how much money and who is owing money to whom. That would be encrypted, and I might have my password, Trevor would have the password to his folder, and George would have the password to his folder. So now the first step would be, okay, how secure is that? And the point of failure would be, okay, can I crack the code? Meaning, can I break up the digital safe? And that, as Trevor and George said, is virtually impossible. Just, that is military grade encryption standard. That's almost impossible. What you can do is to basically brute force the password and try all the passwords and maybe get then into, let's say, Trevor's registry in Trevor's ledger. That wouldn't help you as a intruder, because George and I still have the record, how much money Trevor has, how much money George has, and how much money I have, meaning you would have, or it would be necessary to invade all three homes of us, or computers or whatever, and force us, or to basically penetrate that, let's call it virtual safe. And of course, when we talk about blockchain and cryptocurrency, that's not only 3 persons, but millions of people all around the world. And that is virtually impossible to do. And also kind of removes the government from the equation, because even for a government, that would be really hard. So I just want to highlight the point that whenever we talk about hacking or cracking or security, it's always too important, okay, what risk are we talking about? Are we talking about the risk of theft, of counterfeiting, of stealing, or whatever risk we're actually talking about? Because I think that's important to distinguish between the different risks that we actually have.
And something to point out as well, the major hacking of that Poly network, they actually start to give back the money, or sorry, give back the crypto. And one of the discussions that came forward as a result of that spoke to, one of the key features of decentralized systems in that way, is because when you remove $600 million of crypto from platforms and blockchain-based systems like that, you have to put it somewhere, and it suddenly becomes very difficult because of the transparency and tracking capabilities of what prevails. It gets very difficult for you to then take that currency and put it elsewhere, because somebody's going to know, right? And that speaks to the kind of transparency and security that is inherent in blockchain-based and crypto-based systems. Because I can steal it, great, can't use it though, because I have to put it somewhere to use it. Now, because of the nature of how the information is stored in these systems, it becomes very difficult for me to take it and put it somewhere else. And that's a testament to how these sorts of systems work. So, on the flip side of what happened, the hackers who fleeced the funds on that exchange started to return it. And one of the views is that, they couldn't put it anywhere, because in trying to put it somewhere, somebody would know, and then they'd get caught, right? So that's something to be aware of as well.
All right, let's move on with the questions. Jason is asking, what I'm curious about is, if it's not on the blockchain, how will the currency be distributed? I don't know if we already touched on that, but maybe one of you gentlemen can give a quick answer to that.
Yeah, I think George touched on that earlier.
I think we touched on it earlier. I mean, you don't need to have like I said, you don't need to have a cryptocurrency to have distributed currency. Anyone who has a mobile app on their phone right now is able to transfer fiat from one bank account to the other. Basically, what they're doing is just federating that system so that it's across a national platform. So it doesn't have to be a cryptocurrency, but it's not going to have what we call the inherent characteristics of crypto, however. But very possible to do it without cryptocurrency. If you look at what's happening in Nigeria and most of West and East Africa, they're using platforms owned primarily by cell phones, but by mobile phone operators. where they have wallets set up on their mobile phones where they can get remittances in, and then they can do local transactions as well. And it's not crypto based, so
Right.
it doesn't need to be.
Yeah. It's really just a digital version of fiat currency. That's all these guys do.
With all the inherent risk that comes with that.
All right, I think we can answer one or two more questions before we have to wrap this up. So yeah, feel free, if we haven't answered your question yet, put them now in the chat, in the comment section, to make sure we get a set of new questions that we haven't touched on as yet. And in the meantime, I will put this one up because I think, I touched on it very briefly in the beginning, but I think it's an important point to make. Matthew is asking, are there any concerns on your end regarding the power CBDCs give to the authorities now and authorities to come? And I give my opinion first, and then, gentlemen, you can share yours. I think that is a valid point of concern because, as I said earlier, when you, for example, look at countries like China, where you have a very authoritative government that basically controls all your life, your social media, and your money, there are easy scenarios, or you can easily think of a scenario where people say, or the government says, well, I don't like Trevor, George, and Simon because they talk about stuff that we don't like the public to hear. Now we press a button and all their money that we as the central bank controls and they have in their account can't be used anymore or is rendered worthless, or whatever. They can't really do it, at least not that easily, if we have that money in cash or in another form. So I think that is a very valid point of concern. I don't really have an answer to that problem, but I think that's something that we have to keep in mind, and that I think is generally important from my point of view, that we always should look for a system where we do not have that single point of failure, or to put it differently, where not one entity or one person has all the power or too much power. What do you guys think?
Yeah, as in the case with anything in the digital realm, such as CBDCs, the power rests in the fact that everything's going to happen faster. They're going to be able to track things faster. They're going to be able to effect certain actions faster. It happens, it exists now because even if you decided doing everything in cash, the cash going to run out sometime. Just might take a longer time to run out, and you have to go get some more. And if the point at which you are getting your cash is trackable, then you're not going to get the cash. With CBDCs, authorities are able to know, and this is why there are huge privacy concerns around this new regime, which again is no different from any other digital system, but tracking your transactions, where you spend it, what you say. In fact, I did an interview yesterday when someone was asking, the concern was privacy and the fact that now banks and the central bank and perhaps the government will know what you spend your money on, where you spend it, and who you spend it on. And to that, my question was, my answer was, yes, it's true, but somebody always knows where you spend your money. Okay, you have to give it to somebody, right? You have to buy something from somebody. The whole idea with this is that all of that information is happening at lightning speed now. So that's really how you have to look at it. The power is in the speed at which they are now going to be able to know what has happened to that money that you're using. With that comes the ability to make some decisions a lot faster in a more informed way.
So on this topic, I would like to say that as the world becomes more PC based, more digital, everything you do will be tracked. Okay, so there's no getting away from it. In terms of currencies, I think that you will see, regardless if the state decides to use the information or not, that as you do more digital transactions, which is the way that the world will go, particularly now that cash is a vector, given COVID, because we still handle cash, and that's something that is passed through several hands. As other diseases and viruses come up, you're going to see less and less use of cash. And simply as we become more digital economies, we're going to see that too. The power that central banks have, I think citizens in each country have to determine how their information is used. And they have to get legislation in place that has the rights to protect user information, similar to what Great Britain has, the EU has, in terms of GDPR, regulations, etc. So there is a concern, obviously, but there are some pros as well. Now, let's say, like many countries in CARICOM and Canada, Europe, etc., have very social systems. So they provide aid to citizens as it's required. That aid is given to elderly, the indigent, and those who are going through distress. In a lot of instances, this aid is a significant amount. How do you make sure that aid gets to the right person? How do you ensure that deceased individuals no longer get aid? How do you make sure that it's being spent in the geography where the individual is supposed to be? So government can then run programs where they issue digital currencies and they can make determinations that a welfare check can't be spent on alcohol or cigarettes, or welfare amounts can't be spent on that, or drugs or anything else. So it gives the government some controls in terms of how its social funds are spent. That's number one. Number two, as right now we're facing a challenge in the world with shipping and freight costs. And it's just absolutely ridiculous. We've seen a 20-foot high cube container usually landing in the region for about $3,000, 1,500 US. Those prices have now gone up to in the region of 6,000 US dollars. I mean, a 300%, sometimes a 400% increase. But the cost of fuel going up exponentially as well. This means that every single good and service will be impacted. We have to look at ways at reducing the cost of doing business, increasing the speed of doing business. Digital does have privacy concerns because everything is on a network. We have to decide who has access to that network. And that's all. But we have to find ways all the time to increase the speed and reduce the cost of transactions. So that's what I would say about that. I'm saying don't worry about, as long as you live in a country, don't worry about the power that government has over what you spend. Worry about your ability to do transactions effectively, globally, safely, and legally. So let's look at it from that viewpoint instead.
All right, so I just had a look at the chat and the question. I think we covered the most important ones so far. So yeah, I would say we wrap it up at this point. If you're watching right now and we yeah, maybe missed your question, or you have another question, feel free to put it in the chat, in the comment section. It's always a very good feedback for us to understand, yeah, where are questions, what do you guys want to know? Because as Trevor said earlier, I think the challenge is always to communicate these often very complex ideas and systems so that we can understand the practical use case. I want to give everybody, yeah, a minute or two to make your closing statements or your final ideas on the topic. I start. What do I think about the recently minted CBDC of the Jamaican Central Bank? I'm not sure if it's a step in the right direction. I think, there is a lot of potential, generally speaking, in that space. I'm not so sure if the steps that we see right now in Jamaica are the right ones for a lot of reasons that we discussed during this live stream. But I think it's the right step in terms of thinking about these topics, getting experience, getting it to the attention of the people out there, and as a starting point to develop solutions that we can use in the future. Trevor, your thoughts?
Yeah, I mean, I think it's it's a game-changing move, and let me tell you why. The government is big on moving to a digital society, digital economy, for a whole host of reasons. And I think if you don't have the right underpinnings and rails to accomplish that, then it won't become a reality. So I think exploring and eventually, starting to get the ball rolling in the digital currency realm, it's a really game changing move. My concern is really more about the adoption, getting people to buy into it, start to use it, because it requires a certain degree of digital literacy that many people don't yet have and they're not comfortable with. And I don't think we've started sufficient programs to get people up to that speed so that adoption will occur at the rate at which we want it to occur. So while the idea is great, it's game changing, it's kind of like a build it and hope they will come kind of thing, but you're not putting enough signs on the road to tell them this is where it is, right? So I think we need to do some other things to realize the full benefit of what is being done here, and I think over time it will really redound to the benefit of the country and the economy. But there are some other things. The fact that you minted digital currency and you have all that stuff there doesn't mean people use it, right? One of the biggest challenges we have in Jamaica is telling people to go online and do internet banking. They still stand in lines outside of the bank at 8 o'clock in the morning to walk inside the bank and do transactions. Why? They don't trust doing it online. And that's because we haven't done enough to convince them that it's okay to do that. It's trust. So the fact that you have the technology to make these wonderful things happen doesn't mean everybody's going to buy into it and use it. We've done some legislative changes. We have, data protection legislation, cybercrimes legislation, and all of that. So the dots are there. We just need to start to connect the dots and get the main stakeholders, which is the citizenry, to get comfortable with this stuff. And that has nothing to do with technology, can I tell you? That has to do more with awareness, literacy, giving people that warm and fuzzy. I always say that this new way of doing things is really better from you. Realistically, I expect this stuff to start to happen with a generational shift. So my son, who is doing Robux and V-Bucks on his Xbox with his games, this stuff is going to be normal to him. But getting the current, cadre of people requires some work, requires some education and awareness. And I think, that goes beyond just the technology. We have to start changing curriculums in school. We have to have some very serious awareness programs for the public. Media plays its role to educate. Things like this, we need to keep having discussions like this, so what you're doing plays an important role in what we're trying to accomplish ultimately. So that's kind of my view on where things are now.
Cryptocurrency and blockchain are very much going to be aspects of the future, as Trevor just said. I want to applaud the government of Jamaica, not for the choice of vendor, but for having the fortitude to take this project out and actually roll it out. It's no simple task. So I want to applaud them for that. The next thing I'd like to say is that the adoption that we've spoken about depends a lot on education, infrastructure, and what the government really does in terms of marketing and communication of the product. Now, there are ways to drive users there by issuing all their heart checks and everything through a digital platform so that it drives adoption by paying everyone who is attached to Central Gov on the platform. So that drives adoption. That will force people to use it, and you'll get faster adoption there. But that will come with issues in itself. One of the things I'm disappointed about is that it's not on a blockchain platform.
That's two of us.
and this is because blockchain from 2016, blockchain, not cryptocurrency, blockchain platforms and blockchain enterprise platforms was earning $2.5 billion globally. That's been growing at 25% compound annual growth a year since then. So by 2050, or rather by 2025, that will be close to $20 billion. That's 4 years from now. If there is any country in the world that I think pays too much for credit card fees, banking services, and financial audits, it's every country in the Caribbean. Okay. Too much. The use of blockchain underpinning those systems, rather than being afraid of them, blockchain can make those entities a lot more efficient, maintain some of their profit levels, not all of them, but being able to do everything they're doing now better and faster so that they can get greater scale and do more, and perhaps do more advisory work rather than audit work to help us really make a quantum shift forward as a region. We have a lot of risk associated with being highly dependent on external platforms, on external systems. And as we sort of build knowledge and traction in this space, and I want to thank individuals like Gabriel Abed and Barry Gale, who started with the bit evangelization since I think 2000, 2008, 2010, around there somewhere, evangelizing the aspects of the platform, but really being shut out by the banking simply because perhaps they needed to change the narrative so that they didn't make bankers feel that they were trying to drive them to make the next step. But bankers should see how this platform could help them. Citizens could see how this platform could help reduce their costs. Governments could see how you get greater transparency, greater assurance, and greater control with the right rails that manage e-commerce transactions and privacy and everything else. But we are in a place where trust is everything. And one of the things that we have to do as vendors of products like this is that we have to build trust. Trevor made the point that we have to do a better job at selling. When I speak to clients that we are having potential discussions with, unless they come to me specifically for blockchain, I never mention the word blockchain or cryptocurrency because they get glassy-eyed and start to stare when you start to talk about it. So we just talk about the functionality of the product and what the product can do, rather than what the product is. Like, we all know that we turn on the TV and change channels, I don't know how it works, but I know I want one for this reason. So the social science behind the technology is what we need to sell, more so than the technology itself. And I think that's where we need to have a focus, and that's where the discussion needs to be formed around what the technology does and not what it is.
Yes,
That being said, thank you, gentlemen, very much for taking the time, sharing your experience. I think everybody learned something new today. It was very insightful, at least for me. If you're watching this right now, I would really appreciate if you support the course and hit the like button on the various social media platforms. Feel free to share it with everybody that you think should see that type of content. Of course, I would really appreciate if you consider to subscribing to the YouTube channel, where we will broadcast more of the type of content in the future. Of course, feel free to connect with each and every one of us on LinkedIn. And I hope to see you on some future events. Feel also free to sign up for my newsletter, where I have a weekly publication where I share thoughts and insights about economics, strategy, technology, etc. You should find the link down in the YouTube description. And that being said, I hope everybody has a great day, and I hope to see you next time. Bye-bye.
Take care.